This is dated March 3, 2026, and Forbes puts it in plain English. The price of silver was $80.67 as of 10:20 a.m. EST. If you click because the title said they smashed silver down, this is the receipt that the market was in the low, bought us while the war story was still fresh. For your savings, this means one thing. Your insurance asset can move like a risk asset. And if you don't understand why, you'll always feel late and trapped. Now lock the timeline. Because the war angle is not a vibe. It's dated. Invesco wrote, following the U.S./Israeli strikes on Iran starting on Saturday the 28th of February. And it names the U.S. operation, Operation Epic Fury. That matters because it tells you exactly when the fear premium was injected into markets. If you're sitting in cash, this is how you avoid buying the panic top. You anchor the date. Then you watch what the market does after the first shock. And if you only trust official sources, CENTCOM states, U.S. Central Command, CENTCOM, commenced Operation Epic Fury at the direction of the President of the United States. So the strikes happened officially. And that normally means safe haven demand should stick. Here's the problem. Silver didn't just react, it whipsawed. That whipsaw is what steals buying power, because it pulls people in emotionally and then punishes them financially. Now the other side of the title, did silver hit $94? Fortune says, verbatim, at 8:45 a.m. Eastern Time today, silver was valued at $94.26 per ounce. So yes, the $94 handle was real on the record. If you were holding silver, that's the moment you felt relief. If you were chasing, that's the moment you felt urgency. And urgency is where the market usually takes your money, then the smash. Finance Magnates reports, verbatim, silver fell to $83.70 per ounce on Tuesday, March 3, 2026. And it also says from Monday's opening spike above $96. That's the move the title is talking about. From the $94, $96 area into the $85 zone and below. For your savings, this is the warning label. Silver can gap up on fear, then dump on mechanics. And if you don't plan for both, you'll get chopped up. Here's a central contradiction, and I'm going to come back to it until it clicks. War risk shows up, silver spikes like protection. Then it gets dumped like a speculative trade. That is not bad luck. That is a pattern you need to recognize. Because pattern recognition is how you stop donating your money to volatility. And before we go any further, subscribe in this channel if you want a different kind of coverage. Not to the moon hype, not doom porn, but verified receipts and a simple plan for what to do with your cash, your metals, and your risk. Also drop a comment right now. What US state are you watching from, and what time is it there? I want to see how far this message is traveling while the market is moving. Now let's answer the question you actually came for. Who is they, and how does a market smash happen right after a war spike? I'm going to keep this grounded because we're not proving intent with vibes. We're proving leverage, rules, and forced behavior with documents. First mechanism. The market can decide that the real safe haven is not gold or silver in the short term. It can decide the safe haven is the dollar and liquidity, especially if war pushes oil up and inflation fear rises. When inflation fear rises, rate cut hopes fade, yields rise, and silver gets treated like something you sell to raise cash. Trading Economics wrote, silver declined as much as 7% to $83 per ounce, and explains why. A firmer dollar and higher treasury yields offset demand for traditional safe haven assets. Read that again, because it flips what most people assume. If you're a retiree trying to protect buying power, this is why you cannot rely on one headline. You need a rule. When dollar and yields rip together, silver can fall even in a crisis. Second mechanism. Leverage gets punished at the worst possible time, and one institution has the power to do it without making a single trade. That institution is the exchange clearing system through margin requirements. When margins rise, weak hands don't argue. They liquidate, or they get liquidated. CME's clearing notice states, the rates will be effective after the close of business on Monday, February 2, 2026, under COMEX 5000 Silver Futures, SI. It shows non-HRP moving from 11% to 15%. For you, this is not abstract. If you were leveraged, your collateral requirement jumped. If you weren't unleveraged, price still reacts because leveraged players are forced to sell into drops and into thin liquidity. And it tightened again. Another CME notice says, verbatim, the rates will be effective after the close of business on Friday, February 6, 2026. In the SI table, it shows 15% moving to 18%. That is a second squeeze on leverage. So when a war headline later injects volatility, the market is already sitting on a hair-trigger margin framework. If you've ever wondered why the sell-off feels violent, this is one big reason. Here's the contradiction again, but sharper. The world got more dangerous, yet silver became less stable. If you feel angry about that, that emotion makes sense, because you didn't buy silver to feel like you're gambling. But the market doesn't care why you bought it. The market cares whether you can hold through forced volatility. Now, I want to add one more receipt that explains why these drops don't stop when they should. Even mainstream finance coverage described how margin can create a selling loop, especially for retail. CNBC quoted an analyst describing it like this: "It is definitely creating a sort of feedback loop where as prices drop, more traders will face margin calls, leading to more selling and even lower prices." That's not a conspiracy line. That's a mechanism line. For your savings, it means this. In a margin-driven market, the bottom is often where forced sellers finally run out, not where the story feels bullish again. Processing pause. Because this is the part that traps people. If margin rules tighten and volatility spikes, the market can force selling even when the headline story should be bullish. And that's how you get a smash that feels personal. Now the next question is obvious. Okay, but who is on the other side of this market structure? Who are the big pipes? I'm not going to name villains. I'm going to show you documented participants in the benchmark ecosystem, because this is what they looks like in real life. Institutions, not cartoons. LBMA's page says there are 13 direct participants who have been onboarded to contribute to the LBMA silver price, and it lists firms like Citibank, Goldman Sachs, HSBC, StoneX, Jane Street, JP Morgan, Morgan Stanley, Standard Chartered, and others. This doesn't prove wrongdoing. It proves something simpler. Silver pricing is an institutional arena. If you're retail, you survive by understanding the arena, not by pretending it's a small-town flea market. And LBMA also describes the benchmark structure itself, which matters because it's the official-looking reference people assume is untouchable. LBMA states, the LBMA silver price is administered independently by ICE Benchmark Administration, IBA, and calls the platform electronic, tradable, auditable, and in line with the IOSCO principles for financial benchmarks. This is why the market has authority. It's structured, so when price moves fast, it's not because a few people bought coins online. It's because your move is to stop taking it personally and start managing it professionally. Now let's get into futures positioning. Because when people say they smashed it, what they often mean is big players were positioned in a way that made the dump profitable, or at least survivable, while retail got shaken out. The only way to discuss that responsibly is official positioning reports. On the CFTC report, you can see open interest 131,496 for COMEX silver futures, and you can see categories for non-commercial and commercial positions. I'm not asking you to become a COT nerd. I'm asking you to understand that silver is a positioning market. When the crowd shifts, the price can move faster than logic. For your savings, it means you don't buy because you feel fear. You buy because your plan says so. A respected brokerage analysis of that same positioning put it in a sentence that should make you cautious about chasing spikes. Because when specs are not committed, rallies are easier to reverse. StoneX wrote, large specs remain cautious, trimming net long exposure to a near 2-year low, and also, gross longs have fallen to a 13-year low. Think about that with the war spike in mind. If positioning isn't stacked with strong conviction, price can sprint upward on a headline and then collapse when the next force hits, like the dollar ripping or margin stress. That's how $94 becomes the memory and $85 becomes the reality. Now I want to repeat the contradiction in the most useful way for you. War gave silver a reason to spike, but mechanics gave silver a reason to crash. And when mechanics and narrative fight, mechanics wins in the short run. That's why I don't want you making a single decision from one data point. I want you to stack signals, price, margin, positioning, and physical indicators. And yes, physical matters not because it guarantees a moonshot tomorrow, but because it tells you whether the system is tight or loose. Here's one physical side pressure indicator that's been moving in a direction that tends to increase volatility around delivery periods. Registered inventory. Liz Min reported, Registered silver stocks have slipped below the critical 90 million ounce mark to 88,191,059.264 ounces. Official data showed they also explain registered versus eligible. For you, this changes behavior. If you're buying physical for long-term protection, you care about availability and liquidity stress because stress is when premiums and spreads can change fast. You don't want to learn that lesson in the middle of panic. Now, I'm going to protect this video from the quickest dismissal. This is just profit-taking, not manipulation. That could be true, but even if it's just forced liquidation, it still supports the title's emotional truth. The market used the war window to flush people, because volatile windows are where weak hands get removed. And one of the strongest credibility anchors for that is a mainstream explanation that says the crash wasn't fundamentals, it was positioning and forced selling. Morningstar's key takeaway says, a 9% drop in gold and double-digit drop in silver was not fundamentally driven but instead caused by speculative traders forced to reverse positions and sell. Analysts say, that matters for your buying power because it tells you the real risk. Crowding and leverage can turn safe assets into unstable assets. So your defense is sizing, patience, and not chasing. Now we bring in the war angle again. Because here's what the market does that drives people insane. It reacts hard at first, then fades the move unless oil flows or inflation expectations truly change. That's not my opinion. That's a pattern even major analysts talk about. Reuters quoted, the markets are rather dispassionate when it comes to military conflicts. Once the initial spike is over, the initial rally tends to fade. That sentence is your protection plan in one line. It means the first move can be a trap move. So if you're building a hedge, you scale in like an adult, not like a gambler. If you're trading, you respect that fades can be violent. Let me say the contradiction one more time, because this is what you need to remember when the next alert hits your phone. War did not save silver holders from volatility. It invited volatility. And in a leverage market with tight margin rules, volatility is a weapon that doesn't need a villain to fire it. So what do you do next, depending on who you are? If you hold physical silver and you're not flipping it, your mission is simple. Stop letting the paper price bully your emotions. Watch your personal reality, premiums, spreads, availability, and whether you can actually transact. If you can still buy and sell normally, then a screen smash is mostly psychological. If the real-world market tightens, you'll feel it in spreads, not in tweets. If you hold paper silver, ETFs, futures, options, your mission is risk control. Assume another 10% move can happen in 24-48 hours, because it already did. Use smaller size than your ego wants, and have a rule for what happens if the market breaks the $85 handle again. Not a hope. A rule. Hope is what the market sells to retail at the top. If you're in cash on the sidelines, you have the superpower of not being forced. Your move is to build a trigger list. If silver reclaims a key level, with calmer dollar yields, you can scale. If it breaks down again, you wait. Cash is not cowardice when the tape is unstable. Cash is optionality. And now, one more important layer that a lot of people ignore. The public narrative itself can be messy and contradictory, and contradictions increase uncertainty, which increases volatility, which increases forced flows. When you see officials and media narratives disagreeing on the why, markets can get more unstable, not less. NPR framed a contradiction like this. President Trump said, last best chance to strike at Iran's nuclear weapons program. Then it adds that previously the president said that program had been completely decimated. I'm not here to debate politics. I'm showing you why markets whip. When narratives collide, capital seeks liquidity for your savings. It means you don't wait for perfect clarity. You prepare for imperfect reality. This U.S. news piece states, there was no intelligence suggesting Iran planned to attack U.S. forces first, describing briefings that undercut a key argument. Again, not politics, volatility, for your mind. This matters because shifting justifications create shifting expectations, and shifting expectations create liquidation events. That's when silver gets smacked down through levels like $85. Even if you think the story should lift it, now we close the loop with a clean takeaway that you can actually use. The title says they're using war. The documented version is this. War creates the window, and market structure does the damage. If you chase the spike, you become liquidity for the smash. If you plan for the smash, you can turn volatility into an advantage instead of a trauma. Here's your axial checklist for the next 3-6 months. and you can screenshot this mentally. Watch for any new margin notices. Watch the dollar and yields together, not separately. Watch positioning updates for signs specs are returning with conviction. Watch physical indicators like inventory classifications and real-world spreads. And most important, if silver runs on a headline again, decide in advance what you do if it breaks back below $85, because that is the line that tells you the market is still in flush mode. If you want maximum engagement, answer this in the comments with 2 parts. Part 1, your city and the time right now. Part 2, are you a physical holder, a paper trader, or sideline cash? And did this 94 to below 85 move change what you plan to do next? Subscribe in this channel if you want the follow-up, because the next episode isn't where price goes. The next episode is what signal proves the smash phase is over, so you can protect your buying power without living inside a panic cycle